What if a simple smile could completely shatter one of the most important theories in all of finance? Well, today, we're diving into the story of the curve that did exactly that.
Just imagine for a second, a core principle, this mathematical bedrock used to price literally trillions of dollars in assets, was built on a flawed assumption. What happens when the real world decides to suddenly expose that flaw for everyone to see?
Okay, so to really get to the bottom of this whole mystery, first we need to understand the beautiful, elegant theory that pretty much ruled the financial world and the one tiny critical assumption it made.
So, meet the Black-Scholes model. This thing is legendary. It's a famous formula for pricing options. Now, its real power, its secret sauce, came from one key assumption, that for any given stock, the expected volatility, how much the price is expected to swing around, is the same for all options that expire on the very same day.
So according to the theory, if you were to plot that constant volatility on a graph, what would you get? A perfectly straight, flat line. It was so clean, so simple, so predictable. And for a long, long time, this was just accepted as the truth. But, well, theory and reality, they were on a collision course.
So what on earth could possibly challenge such an elegant and established theory? Turns out it took a massive shock to the entire system for the market to reveal a pattern that absolutely no one saw coming.
The date is October 19th, 1987. You might know it as Black Monday. A huge global stock market crash sends pure panic ripping across trading floors. And in all of that chaos, in the aftermath, analysts and traders, they started noticing something weird, a strange new signature in their data.
Yeah, this wasn't some slow academic discovery in a quiet library. This was a revelation forged in the fire of a real-world crisis. The crash literally forced everyone to go back and re-examine the models they had completely taken for granted.
So what did they see? What was the strange new pattern? Well, when they plotted the data after 1987, that perfect flat line from all the textbooks, it was gone. Nowhere to be found. And in its place was something else entirely.
This is it, the volatility smile. Instead of that neat, tidy flat line, the graph of real-world option volatilities curved upwards at both ends, forming this really distinct U shape. This was the market in the clearest visual terms possible, basically telling the world, hey, your old theory, it's incomplete.
So this implied volatility thing, it's basically the market's collective guess about future price swings. The smile shows us that the market actually expects bigger moves for options with strike prices that are way far away from the current price. Doesn't matter if they're much higher or much lower. And that, right there, directly contradicts that clean, flat-line assumption of the Black-Scholes model. You can imagine this created a huge puzzle for the entire financial world. I mean, if the elegant, beautiful, flat-line theory was wrong, then what was the real story? Why on earth was the market smiling? All right, let's play detective for a minute. What forces out there are powerful enough to bend that perfect theoretical straight line into this weird curve? Well, the investigation points to two main culprits. On one hand, you've got a pretty simple supply and demand argument. It could just be that traders have a higher demand for these outlier options, which drives up their price and, in turn, their implied volatility. Simple enough. But the other theory, it's a lot more profound. It suggests the smile is a direct result of fear. You see, after 1987, traders started pricing in the risk of another black swan, one of those super rare but catastrophic crashes. So options that protect against a crash like that became way more expensive, creating that upward curve on one side of the smile. So look, this isn't just some quirky graph for finance nerds to argue about. The existence of this smile has very real, very crucial implications for pretty much anyone trading or investing in the markets. Okay, here's the bottom line. The smile proves, without a doubt, that the Black-Scholes model is an imperfect guide. It's not the whole story. It shows the market is actively pricing in way more risk at the extremes than the model says it should. And maybe most importantly, it highlights a constant nagging demand for portfolio insurance, protection against a total disaster. And that calls into question any strategy that blindly, and I mean blindly, relies on that old flatline assumption. So, the single most crucial point is this. The volatility smile is like a scar. It's a scar left by history.
It is the market's memory of 1987, permanently burned into the data, now pricing in the fear that a catastrophe could, and just might, happen all over again.
And that leaves us with one last kind of provocative thought. If we can actually see the ghost of fear from a past crash encoded right here in these financial charts, what other human emotions, greed, hope, panic, are just hiding below the surface of the numbers, waiting for their moment to reveal themselves?